afternoon, everybody. This is Steve Tuttle from Krasney Financial. I'm the Chief Investment Officer, and I want to welcome you for attending our January 2013 investment presentation. Now, for those of you who have been on these calls before, we're going to follow a similar format. We'd like to discuss some key takeaways that we have observed in the markets last year, and quickly review 2012 in general from a high level, and go over what I think was a very positive year for most investors. Then we would go into the outlook looking forward. What do we see in the marketplace from a valuation point of view, a risk point of view, and expected return point of view, and then how that outlook translates to our client portfolios. Exactly how are we positioning portfolios in this marketplace. Before I do begin, though, I did want to introduce a new member to the team here at Krasney Financial. His name is Kevin Schmidt. I think you, if you're a client of ours, you may have received a note indicating that Kevin came on board beginning this year. He's got a lot of industry experience. He brings a wealth of knowledge. He's got a strong background in the investment industry, and we welcome him to our team. So, Kevin, if you want to introduce yourself, please do.
Hi, everybody. This is Kevin. I won't say much so that we can get back to the topic at hand, but I'm very excited to be here. And by all means, reach out to me with any questions or concerns you have going forward, and I'd be more than happy to help.
Thanks, Kevin. Kevin is going to be working very closely with myself and the rest of the investment team here at Krasney, and among his responsibilities will be communicating with our clients, so you can look forward to hearing from Kevin in the future. In terms of key takeaways from last year, it was an interesting year. I mean, the stocks shrugged off quite a bit of worries that, if you recall, about a year ago this time of year, there was a lot of concerns in the markets about Europe, about the debt situation in the United States, about China and other emerging markets going through some inflation. It was an interesting year. With all those risks outstanding, stocks actually put in a very good year in 2012. And I wouldn't limit it to just stocks. It was basically risky assets in general had a very good year in 2012 and outperformed less risky assets. If we go back even further, since the 2008 crisis, those of you who have been listening to these calls and reading our newsletters will recall that we've been positioned for a slow economic recovery, and the economic data has proven that to be the case. So our expectation of a slow economic growth environment has largely been correct. Most recently, the fiscal cliff compromise, which was all over the media at the end of the year and into 2013, there was a amicable resolution. I guess you can call it amicable resolution, but this does not provide a framework for long-term solutions, in our opinion. So while it does provide a little bit of time, I think it basically leaves some hard decisions still to be made. So that's a concern of ours. We do remain cautious in our portfolios. There is still a lot of risk in the marketplace. And if you look at the return side, our expectations are, both on the stock side and on the bond side, for returns to be a little bit lower than they have been historically. So that's a little bit disappointing, but we make adjustments in our portfolios accordingly. All right, I did just briefly cover some of the risks that were outstanding in 2012, and many are still out there today. I mean, the European crisis, again, Europe has made some moves. They have at least in word made some decisions to reform. In practice, those reforms still need to become reality. The U.S. economy was struggling last year. Most recently, it has been showing some signs of improvement, which is a good sign. Fiscal cliff, as we just mentioned, kicked the can down the road a little bit more with that. And then the slowdown in China, that's still the case, although most recently it appears China is picking up their economic activity somewhat. Last year, the riskier areas of the stock market were the most profitable. Europe and emerging markets outperformed the U.S. stocks. There was more risk there. There was more concern there. But at the end of the year, those areas actually outperformed. In the U.S. market, the smaller stocks, mid-cap, cap stocks, outperformed by a very small amount U.S. large-cap stocks. And riskier bonds performed very well last year as well. Specifically, emerging market debt, high-yield bonds, floating rate loans outperformed your more traditional investment-grade bonds. In our opinion, looking back from last year to this year, the picture is clearly brighter than it was. There are a number of positives, and the economic data, at least in some areas of the economy, are making marginal improvements. Specifically, the housing market and the labor market seem to be improving. Because of that, we do believe it's less likely that we'll experience a severe negative outcome in the near future, but it is something that we can't rule out, and it's something that we're always wary of. This is an interesting chart here, and this, in a graphic, shows since the 2008 financial crisis what has happened to the U.S. economy as measured by gross domestic product. And what you see is that the blue line indicates the real GDP growth of the U.S. economy, and it shows that it basically bottomed in June of 2009 and then has been improving since then, which is good. However, this blue line, which is the most recent or current expansion of the economy, is lagging by a wide margin what typically occurs in the economy after a recessionary environment. And this just confirms our belief of a slow recovery as a likely scenario. It has proven the case in the last 4 years. Time will tell if we are going to catch up to the more traditional expansions, but our sense is that this slow growth environment will continue. And a lot of that comes from the fact that there's so much debt in our economy and really in the global economy that needs to be worked off. This is creating a major headwind to economic growth, and that should continue. Which gets us to our outlook looking forward. Slow growth seems to be the theme of the call so far, and we've talked much about it in the past, and that's still our base case scenario. As I mentioned before, there's a combination of negative and, fortunately, some positive effects that are occurring in the economy right now. On the negative side, in order to work off the debt that is a big burden on the economy, there is going to be a negative impact from higher taxes and spending cuts, which we think are still to be made down the road. On the positive side, capital spending is improving. Companies are starting to open up their wallets and starting to invest. The housing market is showing signs of a bottom and improving. And the labor market is also showing some signs of improvement. So those are all good things. Hopefully they're the start of more to come. Also looking forward from an inflation point of view, the expectation in the near term is for inflation to stay right around where it is, around 1.5%, 2% in that range. That's probably going to continue. However, longer-term interest rates have already started to drift up, and that trend also may continue and could spike up swiftly at some point in the future. It's something that we're wary of. So we're staying away from the long end of the yield curve. And then the easy monetary policy environment is likely to continue. This is a positive influence on the economy, and really what we mean by this is that the Federal Reserve, the Fed, is likely to keep short-term rates near zero for the next year and beyond, maybe even in 2015, 2016. That's what they've said they're going to do. And I just said, that does have a positive influence on the economy, but it does make it difficult for income investors because short-term rates are likely to remain low. Just to cover some of the more encouraging signs, which I briefly mentioned, the housing market is showing signs of improvement. This is long overdue. This is a very good sign for the economy. Low interest rates do make it supportive for economic growth. It makes it easier for companies to invest in their businesses and in new jobs with lower interest rates. Credit conditions remain favorable. Liquidity is positive, and companies do have a lower cost of debt. So again, this is all has the effect of spurring some growth. And the labor market is slowly healing, though it remains weak in historical terms. And finally, corporate earnings are strong. That's probably the most encouraging sign of the economy, is the way corporate balance sheets have been able to improve and are now quite healthy. And then that's a good sign for high-quality stocks. It's also a good sign for the corporate bond market.
I would also respectfully add the fact that the S&P crossed 1,500, and the fact that the market is at a 5-year high has got to be helping people feel wealthier again, beginning to have some of those old feelings of prosperity.
Absolutely. Thanks, John. So how are we positioned in our client portfolios right now, given that outlook, given the risks that we see on the horizon, but also some positive signs that are creeping into the conversation? What do our portfolios look like? What are our biases built into those portfolios? Well, caution is still the name of the game for the majority of our clients. Risks, although lower than they may have been a few years ago, there's still real risk out there in the marketplace. And the returns, the expected returns, are lower than historically they have been. And while John points out that the S&P 500 hitting or surpassing 1,500 could have the effect of making people, investors, feel better, it also has the effect of decreasing expected returns into the future. You have to pay more for each dollar of earnings than a year ago. I don't think valuations are absurd. They're certainly not, I wouldn't call them expensive. I would say they're in a fair value range. But as the market rallies higher, it puts a little more pressure on those corporations to generate higher earnings. In terms of stocks versus bonds, in all but our most pessimistic scenario, so in all but a recessionary or deflationary environment, we believe stocks should outperform bonds over the next 5 years. And this is not something that should come as a surprise to most investors. Stocks do have a little bit more risk inherent in them, and they have historically provided higher returns over bonds. In the recent past, however, bond returns have actually kept pace with stocks, and depending on your time frame, looking backwards, bonds have actually outperformed certain sectors of the stock market. So there are some investors that have been conditioned recently to expect high returns from bonds. Well, we think the trend, the more normal trend of stocks generating higher returns than bonds is most likely over the next 5 years. And while we don't think stock returns are going to be excessive, we're not expecting ultra-high returns, we also don't believe there's any reason to give up on stocks just because there's some risk out there. There is some growth potential in stocks, particularly in higher quality areas of the market, particularly in emerging market stocks, U.S. dividend-paying stocks, even European and more developed market stocks. So there's every reason to maintain exposure to the stock market. Now, on the fixed income side, with interest rates dropping to near all-time lows, it does make it more of a challenge to income investors. But we are finding decent opportunities outside traditional investment-grade bond markets. So we are using some very flexible, absolute return-oriented bond fund managers to find and take advantage of unique opportunities in the fixed income space. On the individual bond side, we're not buying the highest credit quality bonds out there. We're avoiding treasuries. But John is finding value still in investment grade, but more in the
triple B range.
Triple B range, double A range, single A range, right? There's value there on the corporate side and certainly on the municipal bond side. So there is, with proper research and discipline, there is an opportunity to have a bond portfolio that can provide some income and some stability for a balanced portfolio. And the other area that we are increasingly expanding in our portfolios is a broad category which we refer to as alternative investments. And essentially, we're finding opportunities to invest in securities and asset classes that are not dependent solely on what traditional stocks and bonds are doing. So if you've noticed the transactions in your statements the last few years, we've added some merger arbitrage funds. Some of our clients, we are doing options overriding strategies to generate a little bit more income and provide some downside protection. And then we're also using flexible fixed income strategies through a variety of bond funds. We also own some structured notes which provide exposure to the stock market with some downside protection. So just because our outlook for traditional stocks and bonds is not overly exciting, it doesn't mean that there's not opportunity out there. What it does mean is that we all have to work a little bit harder to find that opportunity and properly construct a portfolio to meet the goals. So if I had to summarize our current positioning, and this is just in a general sense, we look at the portfolio into three main parts. There's the core part of the portfolio, and this is your basic traditional stocks and bonds. And we're essentially neutral on investment-grade bonds, but as I mentioned earlier, we're avoiding treasuries and we're avoiding the long end of the yield curve. We're cautious on stocks, but we're being very selective. There are certain areas of the stock market, like dividend-paying stocks, that we really like. We do think they're very attractive. The tactical side of the portfolio, this is where we make adjustments to the portfolio with the goal of exploiting opportunities. And the opportunities that we see now are focused on emerging markets, both on the bond side and on the stock side, and on equity income, dividend stock funds, ETFs, and other specialty income securities in client portfolios. The alternative side, I mentioned in the previous slide, we're using this to provide some stability, but also some return potential. And we're finding opportunities there in structured notes, arbitrage funds, and for where appropriate, operate option strategies.
Now, let me ask a question on behalf of those listening. Do you think that the new tax rates on dividends could have the effect of moving the market more in the direction of growth stocks, where there are less taxable dividends, and therefore have more capital gain as a total return, rather than a combination of taxable dividends and capital gain? You follow what I'm saying?
I haven't seen any signs of that in the marketplace right now. There was conversation about that at the end of 2012. You did see a number of companies that changed their dividend policy. There were a number of special dividends that were paid towards the end of the year. Companies like Oracle, which was paying a reasonable dividend in 2012, they essentially paid out their entire 2013 dividend at the end of 2012, and then reduced their dividend. So there are situations where corporations are making some adjustments to how they distribute capital. But in terms of fund flows and returns of the marketplace, there's still a lot of value in dividend-paying stocks, and they continue to perform very well.
Okay. Thank you for that.
All right, this slide, I just want to cover two general concepts that I think are important to revisit from time to time. One is the whole concept of risk management. Everyone was cognizant of risk management in 2008, but now that we've seen a nice rally in the stock markets and other risk assets, I think it's important to revisit the real value of risk management. Capital preservation or trying to avoid drawdowns, trying to avoid losses is a very important and critical goal for investors, particularly for investors who are near or in retirement. The issue is that when markets become volatile, and even in last year, although we had a good year, there was a lot of volatility in the marketplace. When markets become volatile, particularly on the downside, many investors have a tendency to let their emotions get the better of them. And they can make some decisions which cause them to deviate from their long-term plans and make poor investment decisions. And this can have the effect of hurting their returns. We believe that any investment strategy, especially for retired clients, needs to pay careful attention to risk management. And any strategy that neglects preservation of capital of one of its goals will probably fail a retail investor at some point in the future. And unfortunately, that did happen to many people in 2008. They had an investment strategy that perhaps was a little bit too aggressive, and then when markets began to stumble, they sold out, and they never were able to participate on the upside. Now, we approach it not from a point of view of trying to time the exact point or price level to buy and the exact level to sell. We tend to have a longer-term time frame, and we're very cognizant of risk management in everything we do. And part of what we're trying to achieve is to smooth out those bumps. All right, we definitely want to participate in the upside when the markets move up, but we're willing to give up some of that upside in order to avoid those losses when they occur. And in any investment strategy, there will be some losses that occur. If you have a properly constructed portfolio, hopefully those losses are not significant to the point where you need to make major adjustments to your plan. So one consistent theme throughout all of our portfolios is to try to avoid most of the downside and participate in a lot of the upside of the marketplace. And if we can do that consistently, I think it's much better for clients to stay on track to achieve their goals and not to let emotions play too much of a role in terms of causing them to deviate from their long-term plans.
I would say that looking at the performance figures for our three oldest portfolios, conservative, balanced, and growth, we now have 10 years of history, and investors can see what the performance has been of those three categories, growth, balanced, and conservative, all the way back by category for 10 years. So there's a fair amount of history available. If anybody's interested in seeing it, they can just call the office and ask for a copy of our performance report.
And the last topic that I wanted to cover has to do with taxes. And for many investors, taxes creeped up a little bit as a part of the fiscal cliff. Thankfully, they didn't increase as much as they could have, but I think that conversation is not done yet. The main point I want to make here, though, is not trying to predict what will or won't happen with tax policy in the U.S., but I did want to emphasize a major component of tax planning that we do in the office here for every one of our clients. And essentially, we look at portfolios as one pool of assets for each of our clients. And many of our clients have multiple accounts. So they may have some accounts that are taxable, some accounts that are tax deferred like IRAs, profit sharing plans, etc. And so we have a targeted pool of assets that we want to invest in for those clients. And the concept of asset location essentially means you want to, or we as your investment managers, we want to place securities in a portfolio where we can maximize after-tax total returns for the portfolio as a whole. So what do I mean by that? Well, in taxable accounts, where any income that you receive or dividends that you pay or capital or dividends that you receive or capital gains that you profit from, those are all taxable events. So the securities that we invest in for these taxable accounts, we want to minimize those tax effects. So you'll see typically municipal bonds, very tax-efficient exchange-traded funds, and some other specialty securities like master limited partnerships, perhaps, in taxable accounts. And these types of securities should have the effect of keeping taxes fairly low. Any gains that we generate, we try to keep them at long-term capital gains rate. Dividends that we do receive, we try to focus on qualified dividends that aren't taxed as regular income. Now, for other securities which we find very attractive and we want to own, as an example, emerging markets debt. That's one of our tactical themes right now. While that's an attractive asset class, emerging market debt pays taxable income. So it's much more attractive for an investor to hold emerging market debt in an IRA account, where that tax is deferred until the money is withdrawn. So we look at the portfolio, we look at the securities we want to invest in, and then we locate the securities in either the taxable account or the tax-deferred account, depending on the tax implications. And again, by approaching this with discipline, we do believe that we can potentially increase the after-tax total returns of our client portfolios. John, did you have anything you wanted to say?
I just wanted to explain, over the last couple of months, I have had the opportunity to sit down with several prospective clients who have come to the table with portfolios of very long interest-sensitive securities due in the 2030 to 2040 range. And, everybody is so starved for income that people have a tendency to do what we call chase yield, in which case they go hell-bent and toss maturity considerations out the window, and they buy the highest possible income-producing assets irrespective of when they're due. And I just wanted to recall to those of you who are listening the status of the bond markets in the late 70s and early 80s when Paul Volcker was trying to get an arm around inflation under the Carter administration that was hitting 13%. We were talking about residential mortgages that were being put in place at 18 to 20% and money market accounts that were in place at 10 and 11%, municipal bonds that were in place in 10-year and 15-year time frames at 10, 12, 13% tax-free in certain cases. And in fact, at that time, the 30-year Treasury hit 16% non-callable. And the point I'm making is that when those interest rates were rising to those levels, people who were sitting in bonds that were current issue bonds of the New York State Urban Development Corporation, the Housing Finance Agency, the New York State Dorm Authority, were buying bonds at 6 and 7%. And a year later, we're looking at those bonds valued at 60 cents on the dollar, at as much as 40 and 45% discounts in value. So it's really important with interest, in my view, with interest rates positioned as they are at what would appear to me to be virtually the bottom of the interest rate scale, to be cognizant of the damage that can be done to a long-term portfolio. Quite frankly, a 5-year, 6-year, 7-year, or 10-year ladder of bonds provides fuel as cash to reinvest into those rising rates. And it's very important that people keep that in mind and not throw reason to the wind and invest in preferred stocks or in very long bonds with maturities that run out in the 2030 to 2040 maturity range, in my view. That's how we're investing for the firm.
Thank you, John. I don't see any questions in the chat box. If anyone has a question, please ask it now. But as always, you're always welcome to pick up the phone, send us an email, and contact us directly with any specific questions or general questions. So with that, I thank you all for participating. I thank you for your time, your continued trust, and of course, thank you for your business. Good night, everyone.